Hello and good morning, listeners. We begin with TGIF after a long, heavy, and active week for the financial markets. This is Almus Market Mornings with Shikhar Garg, and let's dive straight into our updates for the day. We have had ECB and BOE raising rates yesterday, led by the Fed by 50 basis point. But what's quite interesting is the commentary received post these rate hikes. BOE stated Britain's inflation may have already peaked, and two of their policymakers believe interest rates are already high enough to drain pricing pressure. On the other hand, ECB gave a quite certain forward guidance on the series of rate hikes to follow over the months. So, JK, I'd like your thoughts on these central bank policy updates as well as the financial markets. And folks, I will have to give you some fair warning before we begin. It can stretch a little this time because we have had this kind of a week. JK, please go ahead.
Good morning. Yes, Shikhar, I think probably this also will be the last very active week because then next 2 weeks are going to head into the Christmas and New Year celebrations. And why not? The traders might actually mean when they say TJF today. What we have witnessed this week, or rather even yesterday, is a historic synchronized action and messages from four major central banks: Fed, Swiss National Bank, Bank of England, and European Central Bank. In fact, there were 7 central banks who raised policy rates yesterday. As to the major four, raising rates by hefty 0.5%, mincing no words to indicate more such hikes, indicating fight with inflation is far from over, and economic downturn is inevitable. And something unique is that they would be quietly celebrating the sharp negative reaction from the markets because the recent rally in markets had been easing the financial conditions, muting the effect of their inflation fighting actions. It was a big volatility day across markets triggered by central bank decisions, as I said. BOE raised by 0.5%, but at the same time said inflation had peaked and economy is entering a prolonged recession. Further interest rate hikes would be necessary. What was interesting about BOE was the voting pattern dispersion, with 2 votes for unchanged stance. That's surprising, and 1 vote for 75 basis points, and the rest for 50 basis points hike. ECB took the crown for initiating one of the biggest risk-off moves in recent times. Not so much with the hike in policy rate by 0.5%, as much with the president's statements. Lagarde was definitely hawkish in her tone and forward guidance with telling words of substantial upward revision to the inflation outlook, and that interest rates had to rise significantly at a steady pace for a period of time. There would be 50 basis point hikes for some time. She also hinted at wages rising faster than normal and underscored signs of increasing inflation expectations. Laid out plans also for quantitative tightening at 15 billion euros per month starting in March, to be further revised from July. So massive moves were seen in European yields post most hawkish hike from ECB. German 10-year rose by 21 basis points, Italian by 33 basis points, and Spanish by 25 basis points. All this happening even as the economy is expected to enter recession next year, and huge challenges of energy supplies going forward remain unresolved. Another factor investors were looking at was the TPM, that is transmission protection mechanism, about which a lot of discussion happened some months back. That seems to have been forgotten. It was meant as a process to keep the peripheral countries' yields like Italy in check, but yesterday's rise in yields does not bode well. Some analysts are raising the terminal ECB rates as high as 3.75% from 2.75% recently. So the top 3 central banks raising interest rates by a hefty 0.5% and promising more while keeping the terminal rate open, even as all of the economies are expected to enter recession next year, was the worst news that investors would have got. That was promptly reflected in stocks, with global composite index slumping 2.7%, German DAX by 2.65%, Dow 2.25%, S&P 2.5%, and Nasdaq 3.23%. After all, how can anyone even dream of companies doing well in an atmosphere of rising financial costs and slumping demand? Adding to markets moves were the set of weak economic data from US. Month-on-month retail sales for November at minus 0.6, versus 1.3% rise previously. Empire State Manufacturing and Philly Fed Manufacturing indices coming at negative and far more negative than expected. And monthly industrial production slumping minus 0.2% versus expectation of improvement to 0.1%. Manufacturing slumped by 0.6% versus plus 0.3 last month. These are strong signs of economy weakening, with housing sector already seen to be in slump. Rates going up further would only worsen these downturns. So we can only see these as start of a fresh bear trend for equity markets. What we should remember is that central banks are not likely to act or react by supporting the markets as they have actually done in the past, because they desire that market falls and tightens the financial conditions so as to rein in demand. So no central bank will be coming anytime soon. So what will investors buy in these conditions? Maybe more allocation to cash as short-term interest rates are higher, selective allocation to bonds, reduced stock allocation, perhaps increase gold in their portfolio, and in my view, some of the EM countries like India may be on the radar as well. Currencies had a record two-way volatility post mentioned market events. DXY slumped more than 1% after ECB decision. Euro hitting a new high at 1.1739. But dollar index rose 1.3% later as conversion hit the markets and stocks slumped. But fresh buying in currencies is seen in Asian time as high yields, particularly in the euro, supported the single currency. GBP had the biggest fall by over 2% and still close at its lows. Slump in major currencies against the dollar also because of heavy overbought conditions after a stupendous rally from late September. Also, USD has lost its I would say USD has lost its previous edge, with other central banks now openly declaring a strong fight against inflation through hefty rate hikes. So, despite the moves seen yesterday of risk aversion and the dollar improving, I think the previous strong rally in the dollar has lost its momentum. While we may see some corrective strength some more time, the medium term, we see the currency of those economies improving, which withstand these current challenges better. Coming finally to the rupee, it kept to its recent tryst with underperformance, even as dollar index kept sliding for most of the day yesterday. At the same time, it was eager to latch onto weakness in Asian currency post-Fed meeting. We did see some natural flows on the day to start with, but found intense buying on dips, and recent lows at 82.40 has become solid support. Return of dollar strength in the US session with risk assets cratering saw it almost hit 83 levels, but is seen consolidating. Ever since its bounce from 80 to 15 last week, the currency has shown no sign of easing, which has encouraged more bullish approach. A pleasant surprise came from the trade deficit number for November, dropping to 23.89 billion versus 26.91 last month. Imports coming down and exports rising strongly, and this could help to shore up the rupee somewhat, and possibly 83 levels will remain elusive for some time. It is not only the deficit falling, but also the increase in exports that is encouraging, although the expected global slowdown still leaves a question mark over its continued performance. As we go into another weekend, important weekend, because we head into the holidays, let's try to find more concrete answers for the rupee being the worst performing currency, despite being the best performing economy in terms of growth, inflation easing consistently, much closer to a rate hike path ending, much better trade terms for oil now. And recently, the carry attraction has also risen thanks to paying from the central bank, and even trade deficit falling in November. Can these two positives give the much needed boost for the rupee? We will analyze in the coming days. Thank you.
Okay, JK, that was quite good. And yes, folks, we have seen something really historic as all the central banks have had a synchronized action yesterday. As JK mentioned, there's 7 central banks raising rates yesterday. It's quite a significant feat that we have seen over the past few years. On the BOE side, as JK mentioned, they are expecting a prolonged recession, and these rate hikes have had a good dispersion amongst the policymakers with the forward guidance. On the ECB front, folks, it is underscored, ECB has underscored the possibility of the inflation rise, and that's why they've given a very certain forward guidance on the series of rate hikes, as we have mentioned. But what's really interesting to see is the kind of reaction we have seen from the equity markets. Raising of rates, keeping the terminal rate open, has brought down significant indices all across. And why should they not be? As DK mentioned, the rising costs of borrowing and slumping demand can be a major concern. On the domestic front, we have already seen and heard JK mentioning the trade deficit coming down, India being one of the good performers on the macro front, even though the jobs numbers have not been really, interestingly growing. So, folks, it needs to be seen how things go about for India as a nation as well as global economies. We shall come back again with fresh round of updates on Monday. As JK mentioned, we'll ponder a little more over what should be the approaches and the performance of various economies. That's it for today, folks. Thank you so much for listening, and we shall come back on Monday.